Good afternoon. This is Peter Kim with Jonathan Almeida. We're about to start off our session on financial institutions AML KYC challenges associated with correspondent banking. Today's roundtable discussion is held with two panelists, esteemed colleagues of ours, and we welcome all you in the audience to join us for this hour of hopefully educational and fun activities. So today's objective and agenda, we're going to go through some introductions. We'll introduce the panelists, and we'll jump into the topic points, which we have prepared and shared with the panelists already. And we would love to hear questions from the audience. We'll go through the questions afterwards. We have some slides ready for the metrics that we pulled from the answers that we received from all of you. And in closing, we'll go through the questionnaires and the closeout. So my name is Peter Kim. I'm a principal consultant for Withum. Withum is a tax audit and consulting firm, and I work within the forensic and valuation group specializing in regulatory compliance. In my almost 30 years in financial services industry, I've worked in hedge funds and prime brokerage investment banks, as well as BSA AML. And as BSA AML expert and a leader, I've served as a BSA officer for a number of institutions, have been in consulting through Big Four and other smaller companies, as well as being an examiner for the BSA AML compliance for Federal Reserve Bank of New York.
My name is Jonathan Almeida. I'm one of the co-founders of AML Partners. We are a software development company that initiated in 2005. My history goes back with a company called Prime Associates. I worked with that company for about 6 years prior to starting AML Partners. And we're a software development company building solutions for KYC and AML and transaction monitoring and sanction screening. This is our second session that we're conducting with Peter and it's wonderful to have a couple guests with us. So thank you for everybody for joining. We couldn't have done this without you.
Hi, everyone. I'm Bill Radin. I'm just taking the liberty to introduce myself. I don't know how this is supposed to go. so anyhow, I'm the executive director in the legal compliance department at ICBC, and I did the math earlier. I have 17 years in BSA AML space. The last 6 of those in a BSA officer role. I previously have overseen financial crimes compliance units, AML transaction monitoring, as well as KYC. I have never been a sanctions officer, but I do presently oversee a sanctions program and have overseen a sanctions program for the last 6 years.
Hello, everybody. I'm sorry about the video footage. I'm going to be speaking via telephone today. I'm Mark Zoberswag. I'm the Chief Compliance Officer of Israeli Discount Bank of New York. I am the BSA officer and OFAC officer for the company. Prior to that, I was the head of compliance for CTBC Bank, a Taiwanese bank with a New York branch office in New York. I have over 20 years experience in compliance, working for various global financial conglomerates and domestic banks as well. And I look forward to providing my commentary during this panel discussion.
Thanks, Mark.
Great. So a few disclaimers. So contents and statements made in this event are strictly the opinions of individual participants. If we have regulators or news participants in our midst, welcome, but I don't think so. And contents and statements made in the event are not recommendations and not intended as a guidance for regulatory requirements. As some of you may know from our prior session, the genesis for this event was from the fact that obviously we're stuck at home and trying to be productive. We thought that it would be a great thing if we could have an event where we have associates and friends of ours who are in the industry speaking to other folks in our industry and sharing really important and essential information with each other. So we hopefully will have a very frank and hard-hitting session where we ask questions that normally wouldn't be asked in situations like this. So we wanted to provide a session for the insiders who are practice leaders of compliance and BSA AML. The other notes that I wanted to share, we will be posing a number of questions throughout the sessions. This is a way for us to keep track of who is paying attention, and also this allows us to award CP credits at the end. And as before, and with this session, we absolutely would welcome your interactions and questions, and without which this session wouldn't be as much fun. And you could post them on the comment section, and we will share that with the panelists.
Thank you, Peter. We're actually going to get started with that first question. As Peter noted, this is we do need everybody to answer in order to get CPE credits. So we are going to keep this up for about a minute, and let's get our first question.
Matt, did you want to ask, or should I ask?
Yes, I'm sorry. No, that's fine. Regulatory expectations on correspondent banking compliance has been getting tougher. True or false?
With tougher being the operative word.
I'm gonna bet it's true.
we are seeing an interesting unanimous thing so far. So we're at about 75% of people participating right now. So if we get higher than that, we can close this out shortly. I know we have a lot of important matters to discuss. Okay, so I'm going to give it about 5 more seconds if you can give your thoughts right now. Okay. So as you can see, unanimously, it was true.
Good answer.
That's per expectation. That's pretty good. All righty. So here's the boring definition part. So I'll try to go through this as quick as possible. So a definition of correspondent. What is correspondent banking? Correspondent bank is a bank that provides services on behalf of another financial institution. It can facilitate wire transfers, conduct business transactions, accept deposits, gather documents on behalf of another institution. And typically, correspondent bank is typically used in international buy, sell, or money transfer transactions to facilitate foreign currency exchange and payments. And since correspondent banking transactions are US dollar based, it will pass through the Federal Reserve System and subject to FinCEN and US BSA AML regulatory compliance requirements. Type of transactions that I've seen personally, I'm sure the rest of you have seen as well. Lots of folks use correspondent banking activities for processing home remittances, trade finance payments and settlements, bank-to-bank transfers, and international transfers between affiliates, especially the ones that are in different countries. And due to the number of parties and institutions involved, and it could be minimally 6 parties. So originator, beneficiaries, their banks, which is 2, and their correspondent banks. And sometimes I've seen more than that. With all these different parties and the data that's flowing through, you tend to see a lot of problems for people who are on the compliance side. So again, I'm going back to my BSA officer days, but the 3 issues that I would think would be preeminent in terms of the corresponding banking challenges. One is data and technology. Since you have minimal of 6 parties, 6 data sets with different folks touching SWIFT data sets and sometimes not inputting the information in the right places, and at the institution side, taking that information and mapping it correctly to the bank systems, which monitor and measure information for transaction monitoring normalness. So the data technology aspect of it is very challenging. And also access to information. Since we're dealing with not only our customers, but our customers' customers, we don't always get to see all the information that's coming from the origination to the final destination. And another challenge, and I'll take a higher hand at this, there always isn't a sharing of culture of compliance. So the sting that we feel in the BSA officer's role in the correspondent banks, where you are facing with the regulators being asked to make sure you have a good compliance program in place. The culture of compliance always isn't shared with our other partners that are associated with the institutions. So since there are so many different downstream and upstream institutions, it would be great if everyone's on the same page, but often the case, it's not. So that is the definition of the backdrop. The other things that I want to share with you, and I could certainly go into my personal experience with correspondent banking, but recent public information on regulatory examination and supervisory actions involving correspondent banking issues for banks. I'll just take 3. One was with MUFG back in 2019. They cited CDD deficiencies, risk assessments, and periodic reviews involving correspondent bank. And SocGen, and back in 2017, cited CDD and transaction monitoring deficiencies associated with correspondent banking. And last, Mega International Commercial Bank in 2016, they cited BSA AML role conflict, where a person was a business person and a BSA AML person. Business and AML shouldn't really mix. And program deficiencies was cited, CDD, AML program design, and transaction monitoring deficiencies were cited for Mega. So that is the definition, the backdrop, and some recent actions. Matt, next slide.
Thank you so much, Peter. Before we do that, we're going to just do one more survey here. How satisfied are you with the strength and adequacy of your bank's correspondent banking compliance program? Satisfied, adequate, needs improvement. And as expected, we are seeing a bit more variety in response right now. We're at about 70% of people here. If we are able to get up a little higher, we can close this out shortly. We do need you to respond in order to get CPE. Okay. Going to give it a few more seconds here. Looks like we're leveling out. So looks like we pretty split between satisfied and needs improvement, and then that largest bunch was with adequate.
Okay, so these are some of the questions that we had for Bill, and obviously Mark can jump in and provide comments as well. So from a know your customer and customer risk assessment perspective, the first question is, does the U.S. State Department's INSCAR report on countries or EU's recent 2020 blacklist update play a role in continued customer correspondent banking relationship with financial institutions in high-risk jurisdictions?
That's a very interesting question. So I can answer it with the fact that it should, because these are components that should actually drive your assessment of country risk. Country risk assessment is one of the quintessential benchmarks for defining your overall BSA AML risks. So it does roll up into your bank's overall perception of country risk. Although I will say that there has been overall definitely a trend in the industry against geographic de-risking, opposed to prior years when there was rampant geographic de-risking in response to certain negative news events like the Russian laundromat, Panama Papers, Paradise Papers. I think you find in the current environment, a more informed risk management. So in order to have an informed risk management that takes into account country risk, your bank has to go through to answer the existential question, who are you? And you have to have a defined risk appetite. So that's why my view, my complicated way of getting to an answer on the first one is that it should shape your perception of your bank's risk and of your bank's risk appetite, but it's reliant upon your bank defining a risk appetite and you having a robust risk assessment that measures to that risk appetite.
Wonderful. Mark?
Yeah, just to add to Bill's comments there, the INCR report obviously is a pivotal factor in computing your customer risk rating methodology and ultimately embedding it into your risk assessment. It's just one component. We got the FATF list. We have other lists that we need to be assured of and capture our risks per bank, depending on where you are situated in the organization, in the United States or global or, different banking statuses. But it does play a role in the high risk jurisdiction calculations and overall risk factors and ultimately leading to your risk assessment. So I'm in agreement with Bill on that.
Wonderful. So next, it's good to have two panelists agree. So the next question is, what geographic concern elements are generally evaluated of correspondent banking relationships? So for instance, country of incorporation headquarters, physical locations, countries that their customers are remitting money to.
Yeah, so I would say that, of course, as part of your normal CRR, customer risk rating process, you should be looking at the countries of incorporation, headquarters, etc. But the principal risk driver is going to be, where do they do business? So where do their remittances come from? What markets do they avail themselves to? Because you can be a bank that operates in a low risk jurisdiction, or your clients are in Venezuela, or your clients are in a higher risk jurisdiction. So I think it's important that you understand the markets that your correspondent banking customers do business in to adequately assess their risk. And I think we've seen that thematically through enforcement actions as well as on-site examination.
Yeah, just to add to Bill's comments, when you do your KYC, you need to be aware that, based on the CDD rule from 2018, FFIs are exempt from that rule unless they report to their central bank of their ownership structure. So we need to understand not just the correspondent, but the respondent banks, where they're situated, located, and their customer base. To have a good, suitable program, we get some details on who your customer bases are. They give us their portfolio, and so we understand the nature of the businesses and the transactions they're going to be incurring. So, and then we also need to know about PEPs and OFAC sanctions, SDN lists, and other watch lists. We got to ensure that we have a good centralized compliance program for KYC, in particular correspondent banking, to ensure we're not hitting any AML flags while we do our analysis and reviews.
That's a great answer. Thank you very much. I'm sure that came into play during your time at HSBC. I remember you were quite active there.
That's right.
Mind if I just throw a question in there as well?
Please, go ahead. Yeah.
How about, would you be able to just maybe talk through what the tieback looks like? So, client says they're going to be doing activity with particular countries. 6 months rolls by, activity starts to fall, fees tend to receive through other countries. So what is the tieback? what is the reach out? Is there a reach out to the client base to say, is this going to be normal for you? And if so, and you get some sort of a good response, are you then updating sort of the country profile of the client so that it's going to be accommodating for the future? Is that what does that look like?
I can start with this, Mark. I'll rely on you for cleanup. So with respect to that, when you onboard a correspondent bank, you should be creating an anticipated activity profile. That anticipated activity profile should talk about products as well as dollar volumes and jurisdictions. If there is a deviation from those jurisdictions, that could, if it's detected through your course of normal transaction monitoring, that could be an event trigger for a new review. But most certainly, you need to assess it upon your periodic review. So when you do your periodic review assessment of your corresponding customer's risk, you should be looking at the countries that they're doing business with, and if they are deviations from their customer profile. And understand, is there a legitimate economic purpose for why they are in those countries? Did their client base change? Did their market strategy change? Did the geopolitical risk of the jurisdiction that they worked in change? Like, did all of a sudden this jurisdiction go and have favorable relations with Russia? We need to understand what's the legitimate economic driver for that change to their customer, their transaction profile.
Yeah, I'd like to echo what Bill said with respect to periodic reviews to your correspondent banking relationships. Coming from my past experiences, I had a dedicated senior and experienced KY professional and team to handle these relationships. Obviously, we all know about the beneficial ownership, 10% for most banks for high risk, because all these are considered high. Other factors to complete a review is obtaining the purpose of the account, source of use of funds based on the correspondent and respondent bank information. Highly recommend that we have to reinforce and obtain an org chart, central website, corporate documents to evidence the ownership structure. This should be done on a periodic basis. In addition to that, identifying any PEPs, confirming the reasons for the PEPs, the ownership of entities, and understanding the full-fledged review of the correspondent banks, because we all know on the call, the examiners always ask the first two things. I like to see the risk assessment, and the second thing is I like to do a sampling of your correspondent account reviews.
So then, Mark, just quickly. Sorry,
go ahead, John.
So Mark, so you recommend? Sorry, I took you up on that one. I'll repay the favor in a bit. So Mark, you're saying it would have to occur essentially on that periodic review schedule, not on an sort of an interactive as they conduct activity outside of their framework of countries.
Well, your transactional monitoring system should be able to pick up, as what Bill said, from a transactional standpoint. It would detect any normal activities and flag for activities that are greater than what the source and use of funds are for what they're intending to do with our institution. So we need to ensure that we have just the best of both worlds, transactional monitoring analysis, which is done obviously on a monthly basis, batch mode, and then we also have to do our full-fledged EDD reviews on an annual basis to ensure we encompass everything.
Yeah, I think this is a very interesting trend now that you see in the previous world. I would say prior to like maybe the last 5 years, that you found AML and KYC operate in silos. Now there's most certainly that feedback loop, that if AML observes a trend through the course of the transaction monitoring that introduces a new risk to the customer, it should be fed back to the KYC profile and potentially trigger a new review. Also, AML should be able to rely upon that anticipated activity profile that's part of the corresponding customer's KYC. And they should be able to rely on that to understand if the transaction they're reviewing are typical for this customer, are normal for this customer. So you are seeing this element of cross-pollination between the two groups, when previously there really was a silo.
Thank you for that, Bill. And since John went off script, I'll just do one and we'll move real quickly. Since you guys are talking, I was thinking of my personal experience where I got a nasty comment about one of the reviews finding a nested entity within the correspondent banking. So I'm wondering, did you have issues, problems coming across nested activities within your correspondent banking relationship, and how did you find it?
Well, first off, I'm glad we have our legal disclaimer in the beginning. My views are my own; they do not represent those of any bank which I am currently affiliated or have been. So, with respect to that, the nested, there are certain AML transaction rule sets that could actually identify nested activity. Although more often than not, you actually fall into it. Because there's rules that are created around a number of risk jurisdictions, so we'll pick up if there's multiple countries in the payment. Or you have one. Occasionally, you do pick it up with the banking outside of jurisdiction rule or keyword search, because some of the keywords will actually capture for further credits. So you do see that being detected as part of the course of AML transaction monitoring. I'm not necessarily aware of any bank that has a unique nested activity rule set. And also, mind you, that nested activity It's not regulatory prohibited. It's just an exceeding amount of risk.
Yes,
So
I agree.
Yes.
yeah, so it does come up through detection scenarios, and also it could come up as part of your periodic review, because theoretically you should be performing a transaction review analysis upon periodic review, and you could identify it there. And generally speaking, what I favor, so this is my own personal opinion, I think a bank needs to define what its risk appetite is for nested activity and communicate that to their client base. And that way you manage the clients to that policy. So if the clients do process nested transactions, them, and then if they do it again, so putting them on notice that it's not acceptable.
Yeah, so my take on nested accounts is obviously training is pivotal in the bank. Obviously, we have to train all staff outside of compliance what nested account activities are. I think it's a key area. It's basically a foreign financial institution can secure access in the U.S. financial market through another foreign correspondent bank account. So basically, we could turn down a relationship, but they could actually go use another bank to gain access to the direct relationship with the U.S. bank. So it's a difficult area, but I know what Bill's mentioning, that there is transactional triggers that could lead to that, but you need somebody who's a very, very versed in correspondent banking to help decipher these difficult type of accounts and relationships.
Appreciate your patience on that.
Yeah, I also want to add, I mean, you need qualified resources in the AML space and training in the AML space, but also first line defense too, because the first line defense is going to facilitate this communication with their customer as to your institution's risk appetite with respect to nested transactions. So if they don't know what a nested transaction is or what acceptable nested payments are, that's not going to be a constructive communication. So I think you do need to promote awareness throughout the organization, first line and second line, as to how to identify.
Yeah. So I just want to add one more comment to Bill's. So what I did in the past is that in my past organization, we gave a branch-wide training on all your typologies and one-off issues were concerns that a bank should be aware of. And a lot of these concepts have to be understand. I mean, you can understand it from a text point standpoint, but you also have to know how to use it in practicality in your business day to day and show examples. So this was a learning experience that we gave to everybody, so people were aware of any unusual activities. We could help escalate it as need be.
Wonderful. So in the interest of time, I'm going to go to the last question, which is, what are the recommended actions in KYC when lists like INSCAR, EU blacklist, FATFs pertain to countries update?
The recommended action is that you should be looking at your country risk assessment. I mean, this should be, you have to do, a bank should do it periodically anyway. It should be done at least annually. But if the impact of this update materially affects a large client base of yours, a large client segment, you may need to do an intermittent update to your country risk assessment, and then trickle that down into your overarching risk assessment, as well as then a triggering update to KYC.
I echo everything Bill Radin has said on that. No further comments from my end, but he hit the nail right on the head. Yeah, CRR has to be reviewed at least annually, but also if there's any major changes, it should be reviewed on a periodic basis within the year and discussed with your management team.
We do have a question. Should we answer it before we move on, since it's on topic? Training is fine, but what kind of active controls should compliance have to monitor, identify, and address undisclosed nested activities? TM vendors do not have these available scenarios, which is exactly right.
That's exactly right. I mean, unfortunately, like I said earlier, you might end up backing into nested transactions just through the course of the scenarios that you're running, especially a number with this jurisdiction or keyword might identify them. The important thing is to proceduralize how to identify those transactions for your AML analysts. So you should actually document in your procedures what's an indicia of a nested transaction. That way, I think that at least that's the most optimal coverage you can get without fully effective automation.
Yep. No comment on mine. Go ahead.
Mark, you have no other experience? Like, I don't know if you have some other experience, but that's how I've managed it.
I've seen that before with, going backing through other, alert transactions, seeing that maybe 3 countries or more approach and where the money's going in and out of. But obviously velocity plays a big role, and seeing when accounts are quiet and they moved, 6 months later. So you have to be experienced with typologies and understand the alerts. And as you said, back in and see if you're able to identify these nested relationships. But it's a tall task for not just my organization, or everybody's organization. It's difficult in nature, but it's a concept we need to be aware of.
And why don't we go to our next polling question at this point? Head office or senior management understands and fully supports your bank's correspondent banking compliance program. True or false?
This should be an interesting response.
We do have majority of the compliance folks on the phone, so I guess we know where it's going to go.
Specifically from the Northeast.
Answer honestly.
It is anonymous, so.
Yeah.
That's a good point, yeah, to mention. It is anonymous.
We are at about 65% here. I'd like to close it down in a couple minutes seconds so that we can move on. If you could try to get your vote in now. Okay, looks like we're at about a minute. So it did favor true over false here, but very interesting.
That's good to see, actually. It is. It really is, because that's something that we hear quite a bit on the complaint side. So that's very good to hear. So this is my section. Feel free for everybody else to join in, Peter, Bill as well. So Mark, I'm going to direct some of these questions to you. Good. Well, the first question is, for dollar clearing activity, which is quite prevalent in New York City, what techniques have you seen to normalize originators, beneficiaries of correspondent banking relationship customers? Big common challenge. We touched on this a little bit on the previous screen. But
yeah, that's a very important concept. So obviously we see foreign correspondent banking is all for the purpose of the U.S. dollar clearing activities, what Peter mentioned off in the kickoff meeting, the intro. The techniques to normalize originator beneficiaries of the CBR's customer, obviously, when we do our transactional monitoring reviews, and as we all know, we all have a source system issue where a number of systems do not give us information on originators and beneficiaries and greater information. I'm not going to mention the vendors, of course, but it's a difficult task not just to use our wide world web and these third parties vendors. We have to sometimes go to the option of obviously using a request for information, RFIs, to get more information on the originators, obviously the originator and the beneficiaries. Most banks do have their own RFI questions they use. Each relationship is treated differently, so there might be an RFI that's sent, and then we have to send a follow-up response based on the information we receive. So getting that customers probably one of the most difficult tasks, because we don't know who they are from the US standpoint, and using our third-party systems doesn't really help. So we have to rely on usually a banker to give us the information and get the information from us. And I think that's one of the most difficult challenges in AML transactional monitoring. And that's always going to be a thorn in everybody's program. But they have robust RFI questions in your procedures and share with your training team, and obviously your FIU transactional monitoring team is quintessential in improving your transactional monitoring program.
If you have anything to add to that, your experience.
Yes, I'm looking, well, this is a very pertinent experience for anybody that's most certainly in New York State DFS 504, and the source data component to it. So it related to AML transaction monitoring screening systems. So I think that any BSA officer in New York is most certainly living with this. One of the things I fixated on when I read this question was the word normalize. Normalize, I mean, normal means something different for every institution. You have to make sure that they align with your normal. You have to make sure that your corresponding customers align with your normal. There's certain things that they should not do, like they most certainly should not do, like misuse 202. So if you can ensure that your corresponding customers are actually appropriately using SWIFT, that might be helpful, because we still do see some violations of that or some misuse of SWIFT code. So if they are adhering to the standard appropriate usage and have sufficient transparency in their wire transactions, it should be as best case to monitor as possible. And of course, we have to still do all that data quality checks, data validation in order to satisfy DFS 504.
So where I was trying to go with that question when I put it out was the originating bank where the transaction originates from. There's variations of that originator name where so once the RFI, I completely understand where Mark's coming from. The RFI has got to be sent to your correspondent. They come back and they hopefully they cleanse and provide information about who the originating party is. There is a high risk and high chance that the transaction is going to return back again with the same missing or slightly different originating party. So what I meant by normalize is once there's clarification now on who that originating party name and address is, how can that be leveraged for future transactions that come in where once again, the corresponding bank essentially is just a pass through of that same, the same way of them sending it in the past. That's where I was coming from.
I would say, I mean, many institutions I work for, with their respect to the transaction monitoring systems, employ fuzzy logics and fuzzy matching to better align the transactions if you have slight name variations. Because sometimes there might not be a standard account name being used on the originator side. So at the very least, you can match the originator name through a fuzzy match. And that's something that I do see model validators and regulators being extremely interested in when they test our system.
Right.
I think that's probably the best systematic approach to it. The rest comes to managing that correspondent relationship.
Yeah, I just want to add to Bill's comments on that because that's a good point. You need to have robust systems to capture all your screens and for extreme vetting of your fuzzy logic for OFAC SDN. Some names obviously are going to phonetically change, so you have to have a system that captures pretty much everything, and obviously have a good algorithm to ensure that your fuzzy logic threshold score is set appropriately internally to capture those names. And just to go to what you mentioned earlier, I mean, the SWIFT 202 CUV was created 10 years ago because of the originated beneficiary fields were left blank on the SWIFT system. So that's how a lot of the AML, unfortunately, that's where a lot of the AML failures happen in the wire field areas, because a lot of monies were being transferred without the originated beneficiary information. So that's why the consensus was the MT202 CUV was created to support that. Then you also have to be aware of some of the recent AML TID points. For instance, you could have a bank-to-bank transfer, but the beneficiary on the bottom says to obviously to a to a money service business or charity organization. So you got to be very careful, not just from a compliance standpoint, but a lot of the operations folks need to be aware of some of the AML trends and typologies to pose for risks within the organization.
Great, thanks, Mark. I think the next two, I think we touched on the next two bullet points in this conversation, but if you've got something to add, Mark, on that second item, please do. If not, if you think I think we've covered it in the.
We covered that already, yeah.
Also, in the case of, I think we've provided some examples, but if you think that there are a couple examples that you could use, I think it would be good for the audience to listen in.
Yeah, I mean, as I said, when every bank should have their own RFI procedures, obviously a policy and a procedure. Embedded in the procedure, it should be included, for new and existing staff, that every RFI should be sent out appropriately. And then, as I said, if there's some unclarity on the responses, then a follow-up RFI would be required. Unfortunately, this does take time. Usually you don't get a response for at least 10 to 20 days on average, but refining your RFI procedures on an annual basis and clearly documenting all the questions related to activity is quintessential, very, very important. And you have an RFI process is extremely important to your compliance program.
Thanks, Mark. I'm going to group the next two questions.
Yeah, let me jump in onto the RFI one, because I think this is an interesting topic and something that has become an examination theme as well. So I think it's important with respect to the RFIs that you ensure your RFI questions are sufficiently tailored to the red flags displayed in your alerts. You have an AML transaction monitoring alert, that you're actually tailoring your RFIs to those alerts. I will say also, in the past, institutions have been criticized for using canned language. So language that's too canned and not sufficiently tailored to their investigations. Additionally, you should be managing expectations with the RFI. So I would recommend you communicate to your corresponding customer that if they do not respond to this RFI timely, it may inhibit their ability to process future transactions for this entity. Because many institutions will take the risk mitigating approach of putting that on the filter, that non-responsive RFI, the subject of the non-responsive RFI on the filter. So it's very good at managing their responses to give them that notice. And in addition to it, to add teeth to that, you should track your RFIs. You need to track the responsiveness. And if you find a systemic issue, a repeat issue with a certain correspondent, that could be a material risk issue that you would consider offboarding that correspondent, somehow limiting your activity. I told you it's a favorite topic.
Yeah, no, you're living it. You're living it, Bill. Yeah, I'm sure this could go on for a bit. It's perfect what you said, right? You want to have that teeth, and it dives well into the next two bullet points. The examiners want to know what kind of controls you have in place. What are you doing to mitigate that risk? And it's exactly to your point. You're requesting the correspondent bank to respond by a particular time frame because of what you yourself have to answer. That's answerable. So, Mark, if you want to maybe group those two bullet points together.
Yeah, I want to talk about the experience with examiners in general, actually. So, as regulatory scrutiny increases, regulators do impact how banks' risk appetite is defined. De-risking on the rise because, we don't hear this, the examiners tell us to do it, but we are, is the rewards greater than the risks? We all know that the banks charge and make money for this, obviously $25 to $75 a transaction to do correspondent banking. But I know that the bank, from my own personal experiences, banks examiners focus on FBCs as part of their scope to compliance, OFAC, and operations. They usually request a sample of FBC relationships in different functions, EDD, transactional monitoring, and obtaining the regulatory framework as well. They also, I just want to allude to everyone that they expect walkthroughs with staff and question them on knowledge and experiences by reviewing their resumes and job profiles in advance. They want assurance the individuals involved with the departments handling day-to-day operations are fully knowledgeable on subject matter and understanding what risks can be associated during their daily jobs responsibilities. So.
And as a former regulator, I would say Mark absolutely nailed it well. And there are other things that the regulators may do, such as, I don't know, people talking stuff downstairs, smoking, talking amongst themselves, or in elevators. You have to mind your P's and Q's, especially when the regulators are around. But they are definitely watching, and everything that Mark said absolutely rings true.
Mm-hmm.
I think a lot of emphasis is placed by the regulators on correspondent banking, and rightfully so. I mean, it's very likely the highest risk product your institution offers.
Mm-hmm.
And when they look at, I mean, I think and it's important, Mark, as you highlighted, they look at staff qualifications. I mean, in many cases, they have looked at the adequacy of staffing resources from both the angle of do you have the right number and the right people. There's certainly been recent actions against personnel compliance management, saying that they either did not have the right qualifications or did not drive the right risk management. So I think that having the right people and the right culture, you do see more cultural observations. That's why I think that in some recent examinations that I've been through, there's been an emphasis on training. So they want to see that culture, that you are driving a compliance culture. And correspondent banking, especially your enhanced due diligence profiles, are the focus of their exam. They will look at those EDD profiles and how do they align with the activity.
That's perfect segue into the last 2 points. How important is enhanced due diligence? Transaction monitoring and other activities of the compliance department in your correspondent banking risk mitigation. And I'll group that, Mark, with the last one. What has been some of the successful strategies that you've seen in the industry in addressing correspondent banking risk?
Yeah. Yeah. So I know we all spoke about EDD. Obviously, all correspondent banking is the higher risk, so we all know EDD is quintessential. The examiners, just to go back to that point, they do look at a good well sampling of those correspondent relationships. They also double check, in addition to your full due diligence KYC, they also look at the work papers or the supporting docs to back up your EDD. So I'll give you a perfect example. They do look for the CBBDQ questionnaire that just was revised 2 years ago. And for those who are not familiar, there was a recent update back in April on some changes to that questionnaire, and there's a declaration statement as well in the back. So that document itself has been fully expanded to 100+ questions, covering a lot of basis on correspondent banking. Other banks do obtain an AML letter as well, from a correspondent relationship, and maybe a respondent bank as well. And also the foreign bank certifications have to be updated. The examiners do take a look at those to ensure that they are signed by the compliance officer and they're within the 3-year time period. If not, you need to obtain a new one. As many of us are aware, many are posted on the websites of their banks, but they're not fully, they're not updated. So we have to do our due diligence in making sure we have current documentation on file to support our EDD review process. Very important for everybody, regardless of what bank you work for.
So I would just add, I think it's important as part of the EDD process, assess the control framework at your correspondent banks, ensure that it's appropriate for the business and market that they're in, the jurisdiction that they're in, and that it aligns with your risk appetite. Look at their transactions and go beyond the Wolfsburg questionnaire. Tailor questions to risks that are important to your institution.
It's awesome. Very valuable there. Matt, over to you.
Yes, thank you. We are going to do our next poll here, as we have a lot of great content to still go over in the last 10 minutes here. I just ask to try to go quickly here, but my biggest concern with the bank's correspondent banking compliance program, transaction monitoring program, KYC EDD program, lack of data and cooperation from correspondent banks, conflict of interest between business and correspondent banks.
I think this might, re-looking at this question, I wonder if it should have been a pick as many as you can.
Multiple choice, yeah, all of the above. Answer E.
Okay, we're at about 60% of people here. We're approaching that 50-second mark. So if you could try to get in those last minute votes. Okay, I'm going to close this out. We're at 1 minute. Don't know if there's a.
Yeah, it's high.
Yeah, that makes sense. Okay, so we come to the fun part of the session. We would really appreciate it if the audience members could pop in questions and comments and things that you want to ask the panelists. And we're going to post that to the panelists and we could address it. And while we're waiting for questions from the audience, we did receive some questions previously. We're going to go through those as we're waiting for the questions, right? So the first one, it's a general one. Tell us about your experience with correspondent banks and your career as a BSA officer, and what makes correspondent banking so challenging to compliance officers. And I'll start with Bill.
I think what's the most challenging, and I've been an officer at banks under enforcement action. The most challenging thing is the unknown. You don't know who your correspondent customers are. Your correspondent customers' customers are. So that far removed, you have to be able to have some element of reliance that your correspondent customer has an adequate compliance program and some selectivity in who they provide financial services to. History has showed us that that's not always the case. That certain financial institutions will take whoever they can, and that's contributed to a number of the enforcement actions that were coming in 2012 to 2016. So I think that's the most challenging thing, is you're operating in jurisdictions that don't have the same appreciation for risk that the United States does.
Yeah, I'm going to put a different spin on that. I'm going to say how to mitigate the risks to correspondent banking. So in order to meet the obligation of monitoring and control risk for a financial institution, please ensure your BSA AML policy procedures are reviewed at least annually and adjust to any risks related to correspondent banking activities. Some banks actually have a separate P&P on correspondent banking on discussing risks and typologies to be included. Also, perform an annual risk assessment to determine your AML BSA OFAC program as it relates to correspondent banking. Make sure there's a separate section in there. Risk ratings, products and services, transactions and volumes, incoming, outgoing is critical. Ensure that you understand that to the examiner, you're focusing your risk assessment portion to corresponding relationships. They do want to see that point forward.
Thank you, Mark. So we have a question from the audience. The question is, do you see a continued downward trend in US dollar clearing through the US? Mark, I want to start with you.
Well, we all know for the past 10 years, we've been seeing de-risking efforts in correspondent banking, but to say it's ever going to go away, it's never going to go away, because obviously global customers want to channel their money through US dollars. That's why many of our branches and agencies in New York with European Asian banks have our presence here for that purpose of opening up the branch. It's one of the primary reasons. So to answer that question, we see a decline. Will we see a decline going forward the next 5-10 years? To a degree, yes. But as I said earlier in the call, it's a money-making business and it's a fee-based business, but it's up to branch senior management with compliance input as well. If banks want to, de-risk those efforts to protect the integrity and reputation of a bank in case something ever goes wrong.
I think an important component of this conversation too is that you don't want regulators should not want the industry to de-risk too much, because you're going to be taking US dollar clearing from banks that have the capacity to manage it and knocking it down to third-tier banks that might not have the right appropriate control framework. So we want to see would like to see the larger financial institutions managing U.S. dollar clearing. And I agree with you. I agree with you, Mark. It's never going to go away. But I think that we need to be a little bit more selective in our enforcement so that it's not this knee-jerk de-risking of a very vital product. I mean, foreign jurisdictions are still going to need access to U.S. dollars. And we don't want to exclude a foreign jurisdiction without a U.S. sanction.
Peter, I know there was another question that was posed in the chat session, but I feel that I think the audience might get a lot more out of the second bullet point that we have the question here.
Okay.
If I could ask that, Mark, if you could take that one, and then Bill, if you can come in. What are the main reasons a U.S. FI financial institution decides against the establishment of correspondent banking relationship? If you can give us some examples, that would be great.
Well, I'm just gonna. What are the main needs for U.S.? I mean, there's a lot. I mean, we all spoke about it too. I mean, the risk factor is important. You know, to ensure that we're able to have customers that flow through our banking system, and through that bank to ensure there's no AML infractions. So, I mean, not only does it affect transactions, but then it touches on the OFAC area, you know, and also touches on other areas of risk. So, you know, not every bank is going to be 100% bulletproof from risk, but moving your activities from a foreign bank correspondent relationship is, you know, clean. But, you know, that's how a lot of the global banks operate, to be a presence in that field. So, you know, so that's my high level answer to that, because we could talk about that for hours, to be honest with you.
Yeah, I think the important thing to remember is that the most common reason for de-risking of a bank is either the geopolitical risk doesn't align with their risk appetite. You've identified control issues with their compliance culture and the responsibility as part of your KYC, or simply their suspicious activity. I mean, if you identify a large concentration of SARs with one bank, or particularly problematic transactions with one bank, you should consider whether you would be de-risking that bank.
Yeah, and just to add to your point, follow up. You know, there's, you know, we might see transactions that are complex in nature, trade finance related, downstream access to money service businesses, or transactions with high risk goods like chemicals, or, you know, gold. So there's a lot of downstream effects by onboarding correspondent relationships.
Fantastic. So in the interest of time, we have 2 minutes left. What we're going to do is show the metrics so that everyone could see how everyone voted. Some interesting facts, information there. Matt, next. You want to go to the next one? Okay. So all the information on the responses will be provided as a takeaway for everyone. And we do have an option to continue this conversation. I think as we reach out to all of you, if you feel that, if you would like to invite Bill and Mark back for part 2 discussion, because clearly this is a really an engaging topic with lots of information that we could talk all day, probably much better with drinks on our hands, but we'd love to do a part 2 session. If there's an audience willingness, just let us know and we'll set that up, and we'll go through the questions that we couldn't cover. And at this point, I'd like to really give a heartfelt thank you to Bill Radin and Mark Zilberzweig, and John Almeida, my co-host, and Matt Basillo, who's in the background working furiously with the panel slides and the votes. I really appreciate that. So I want to turn it over to John. John, do you want to say a few words?
I just appreciate just thank you, right? I mean, we were all stuck at home. We were all trying to figure out what to do. This is a nice little outlet to get out to the community. You know, it's nice to see the interaction with some questions coming in. You know, these are real problems, and hopefully we're helping, even if it's for a little bit. Thank you very much.
Great. And the questions that were posed, we're not going to let those go. So what we'll do is we'll ask the panelists to take a look at it, provide some feedback, and we'll go directly back to the person who posed that question. And Matt, if you could make that happen, that'd be great. Matt, any final words to close this out?
Thank you very much. Yes, we can have our speakers and experts reach out to those specific people. As you close out of this, you're going to see a survey. We just ask that you take that. Part of it will be just letting us know, if there's any other topics that you'd like to discuss, as well as just letting us know how you think this went. And as noted, we will be reaching out to you with your CPE credits, and there is going to be a recording of this made available as well that we'll send out to you. Thank you very much. And that's all I've got. I don't know if any of you have anything else.
Bill, Mark?
Oh,
Thank you, guys. It was a fun discussion, and I hope to be invited back to do another one.
Yeah. Thank you, guys. Thank you, Withum and AML Partners, for hosting it.
I do like that idea of having drinks on hand the next time. You're right. We might have to go an extra hour, Peter. An extra shift.
I'll send you beers and pizza. How's that? Okay, we'll do it.
We're not drinking now.
Great.
All right, guys,
Thank you, everyone, and thanks for joining us.
Bye-bye.
Have a nice day, everyone.